In this video, we're going to talk about bond valuation and some of the questions that can be answered utilizing this Excel spreadsheet application. So let's talk in general about the variables. All corporate bonds and government bonds have a par value. They're a loan, so there is a principal, and that principal is fixed. So it's $1,000 always. Now the only exceptions to this could be some United States government savings bonds. Those could have some price that's or some value that is less than the less than $1,000. The coupon is the actual interest that's paid either semi-annually or annually. So in this case, we're going to assume the compounding frequency is once per year. So if we have a coupon of 10%, then we're going to be paid 10% every year, in this case, since it's annual. 10% of $1,000 is $100. So you would receive $100 a year for the life of the loan. Now let's assume that the required return on this debt, which by the way is related to the riskiness of the debt, it's related to interest rates. So let's assume that the investor for this bond, given its risk level, they would be perfectly happy with 8.5%. So what do we know about this bond? Additionally, we know that it has 30 years to maturity. So we have 30 years to maturity on this bond. It has an 8.5% the required return, but they're willing to pay 10%. So what we're essentially saying is that the investors only want 8.5%. The lender, or the borrower, is willing to pay 10%. So this bond is going to sell for greater than $1,000. It's going to sell for roughly $1,161. That's the value, what you'd be willing to pay for it. So let's assume that this bond has a price of $1,150. Now as you notice, we're starting to fill in some blanks as we add the variables here. So what do we now know about this bond? We know it's selling for $1,150. We know investors would be willing to pay $1,161 for it, so this is a good bond. We know that the investors want 8.5%. If they actually paid $1,150, they would earn 8.59%. That is what we refer to as the yield to maturity. This is the return that you would earn if you purchased for today's price and you held it for the 30 years of this investment. The current yield is 8.7%. Now this is just the return that you get on the first year based on the coupon and the market price of the bond. So this is just the first year's return. Your overall return over 30 years is 8.592%. Now the yield to maturity will change based on how the price changes over time, but also the current yield is also going to change as the price changes. So now we have some other questions that we might want to ask. Bonds have a feature called a call feature. Typically, a call feature is the principal or the par value plus 1 year's interest. So in this case, the call premium is $1,100. Now let's say that the contract says that the company cannot call this bond for the first 10 years. So for the first 10 years, there's no call, but after that, the company can call whenever they would like to. So at 10 years, what we find is the yield to call is 8.4%. So again, what does this tell us? Well, investors want 8.5%. The yield to call here is only 8.4%. So if we think that interest rates are going to decline, and there's some pretty high interest rates in this, so there's a pretty good chance interest rates would go down. If interest rates would decline, we might think that we would earn a lower rate of return, and certainly lower than what we want. Again, we always want to compare the yields or the returns that we think we're going to receive. We want to make comparisons to the required return. For the value, we want to make comparisons of the value to the price to determine whether or not an investment is good or not. A final question we might ask is, what if we only want to own this bond? Let's say we want to own it for 15 years. So in 15 years, we think we're going to sell this bond. And let's assume that in 15 years, because interest rates have gone down a little bit, let's assume that the future price is $1,200. So we think it will be worth $1,200 in 15 years. So now, when we calculate this, what's referred to as the realized yield, if we hold it for 15 years, and if the price goes to $1,200, we would earn 8.85%. Again, in this case, it's just telling us, again, compared to 8.85 to the required return, if we think that this prediction is possible, then we would earn a higher rate of return than what we required. So in this case, the only thing we really hope is interest rates don't fall so far that the bond will ultimately be called. Now, one other question that we can ask is about interest rate changes. And we have a statistic that's called modified duration. And modified duration essentially tells us that it's a measure of interest rate sensitivity. How sensitive is the prices of a bond? How sensitive is that to changes in interest rates? And this works really well with relatively small changes in yield to maturity. It will be more accurate for that. Unfortunately, it's kind of harder to see exactly what's going on price-wise. But let's assume that interest rates go down by I'm sorry, that is locked currently. I'll have to unlock that. Let's assume that interest rates change by 0.01, that's 1%. So if interest rates go up by 1%, we're going to find out that there'll be a change in value. And it's the change in value is modified duration times the change in interest rate. So, and it's a negative value. So if interest rates go up, bond prices go down. So the new price would be $878. So if we make it a smaller number, right, 0.1%, again, you see it's going to go down by about -2% is what the change is going to be. There is an additional statistic. And if you look at some of the graphs here to the right, you see that the prices of bonds relative to interest rates, it's a curvilinear function. So when interest rates change, the value changes, but it's not a straight line relationship. So convexity is a statistic that takes into account this curvilinear nature of the price movement and interest rates. So if you look at convexity, the actual change in value, again, it's slightly different. Again, if we do this, let's say it's a -1 price change, right? -1 price change is going to go up 23.63 with just duration, but in reality, it's going to go up more, 26%, is what it's going to go up with respect to convexity. So one of the other additional things that we can kind of look at is what happens to values as interest rates change. And as you see here, as interest rates decline, the value of a bond increases. In addition to that, what is the value of a bond at maturity? In this case, this bond started at $11.50, that's up here. And if nothing else changed over time, but time, as time dwindles away, eventually this bond will have a value of $1,000. So that is the basics of determining value, measuring interest rates, talking about call premiums, talking about realized returns. So it's the basics of bond valuation.